You're listening to a Mint podcast brought to you by HT Smartcast.
Hello, listeners. Welcome to the latest episode of Why Not Mint Money. I'm your host, Jash Kriplani. In today's episode, we'll be examining an interesting aspect of investing that's to do with investment behaviors. Behavioral biases can also impact your investment decisions and investment outcomes. Hence, it is important to be aware of them and in many cases also be wary of them. In today's episode, we are in conversation with Karthick CS, who is the co-founder of Knowise, to talk in more detail about all this.
Welcome to Why Not Mint Money, a personal finance podcast where we help you understand basic money concepts and share strategies for you to build your wealth. So let's get started with your money journey.
Hi Karthik, welcome to the latest episode of Why Not Mint Money. It's great to have you here. So Karthik, we wanted to connect with you and talk to you about behavioral biases and how these can impact investment decisions. So can you start with some common examples of behavioral biases that investors should be wary of?
First of all, thank you very much, Josh. Love being on your show. Thanks for giving us the opportunity. So when it comes to the matter of behavioral biases, I'm sure we all are aware that money is a logical subject. But yet most of the decisions what we end up taking are all emotional. And being emotional is part of our human trait, right? I think right from our earlier days when we've seen our parents went out for shopping for the vegetables, we loved the pleasure of saying that, okay, I got the dhania free. So we always loved these smaller emotional nudges, I would say, or the factors which influence our decision making, and money-related decisions are no exception either, right? I think so. I think the most common bias has been some of the biases what we have seen in the recent past, be it anchoring bias or recency bias, overconfidence bias. Many of these biases have really played part in our decision-making process. If we were to pick a couple of them and then look at them, that would help us to understand where we go wrong, right? Recently, I was having conversation with a couple of investors, and they had said that, look, I've made my money last 5 years or so, and my portfolio has grown, right? I mean, let's say one of the investors was saying, my portfolio has grown from 10 lakhs to 25 lakhs in the last 5 years. And I think it's time for me to safeguard. So one question I asked him was, okay, how are you going to safeguard? He said, look, I will take out my money. So that conversation was very curious. And I asked him this question, okay, now tell me what is your money here? So his answer was very interesting. He said, look, 10 lakhs is my money and 15 lakhs is free money or the money what I've made from the market. So I will take out my money and then leave the rest to the market. So at the end of the day, if you were to look at the portfolio, the entire 25 lakhs is yours. But it's somewhere in the mind, I would have said that, look, let me protect my hard-earned money, the money which is coming easily, let me take risk with it. That is one of the most common biases we would actually come across. The other bias could be the overconfidence bias. Look at last 5 years. The markets have done well, and there are a lot of individual investors whose portfolio would have done much better than some of the selected funds. So there one would say that, look, my own ability is better than many other fund managers who are there in the market. So you are overestimating your own abilities, right? So this is again one of the common bias, what we call it as overconfidence bias. This bias, we kind of establish this with very common questions when you ask people, right? I mean, I ask this question in my session to people. Can you give me the number of countries in Africa, but you have to give me this answer in a range. The people give the range as 20 to 25, 25 to 30. There are people who said 50 to 55, etc. The correct answer is 54, but essentially, even though you don't know the answer, you think you know, trying to be right, you give the answer in that exact range. in the range what you think is right. So that is an example of overconfidence bias. So many of these decisions really go against us because we are thinking emotionally.
Right. And how do you think investors can be wary of these biases? Any other examples you can share? Say, recency bias is also something that we often see. We also often see anchoring bias, but can you give, say, example? I believe a good example would be, and you can add more, is that, we have seen Nifty hit a certain high. Now for
Yeah.
certain investors, that might be something that they are anchored to.
Oh yeah, I think the most common anchoring bias what people think of is 52-week high, 52-week low. But if you were to leave that also, right? And what is a normal assumption one would have while investing in mutual funds? Expect 12 to 13% return, 13 to 14% return. That expected returns itself could become an anchor. That means I assume that every year I'm going to earn so much returns. That may not be the case, right? I mean, we all are aware markets are volatile. We don't control the outcome. Sometimes it could be higher, it could be lower. And of course, we don't complain when markets really outperform our expectation. But we definitely tend to start worrying about it, want to take an action on it when markets deliver returns lesser than our expectations. So that itself could be a classic example of anchoring bias. But also, let me give you one more example of anchoring bias. When people start talking about, okay, let's look at the benefits of mutual fund. So what are some of the common benefits we think of? The common benefits we think of for mutual funds would be portfolio diversification. There are a team of experts who are handling the money. And one more thing which generally excites a lot of people is the flexibility. I can invest anytime, I can exit anytime. Somewhere the moment this word, I can invest anytime, I can withdraw anytime, really catches the imagination of someone who say that, look, I have the flexibility, I can decide when do I invest and when do I withdraw. Imagine if you've invested in an equity fund or an equity-oriented fund which relatively carries higher risk, and also in the back of your mind, you've told yourself, I can invest anytime, I can withdraw anytime. Right now, market conditions doesn't seem so good. Let me withdraw right now, because that's the original purpose or the benefit I probably started with. But that is not the kind of anchoring bias you would have when you're investing in a product like PPF. Inherently, we would have told ourselves a public provident fund is a 15-year product. Even though after 6 years there's a partial withdrawal possible, we don't necessarily think of that, okay, after 6 years, I can slowly start exiting. Somewhere in the mind, we would have told ourselves, this is a 15-year product. So I think these kind of decisions will really kind of derail, it could derail from the path of wealth creation or achieving the goals, etc.
Can you also give an example of recency bias? Because recently, in the sense we saw Sensex correction going down up to 70,000 levels. How does that impact the psyche when recently markets have corrected or recently markets are rallying? Is there an influence on investment decisions because of the recency bias, so to say?
Yeah, I mean, when we speak to the different asset management companies or people who are in the business of distribution, when you speak to them, there is one behavior which people are saying that, look, there are reasonable number of people who are stopping their SIPs in this time or reconsidering their decision of staying invested, etc. Why was that? I'm sure we all agree, large number of investors got added post 2020, that is post COVID. We've seen a new breed of investors who come into market who are looking to invest in markets, looking at returns, great returns. Last 5 years, the experience has been phenomenal. So my experience is that, look, markets can give 20%, 25%. Sometimes you've seen small caps giving 70%. So my recent memory is that, look, markets have potential to give that great returns. But certainly when there is a curveball like this, what we've seen post September, October last year, when markets have been really volatile, and then from 85,000 levels of Sensex going down to 73,000 levels, and then subsequently we've recovered. But somewhere that there is that question mark that okay, um, what is in store in the coming months? I don't know, right? I mean, I believed, or my experience said that it would give such high returns, but it may not be able to give. Now, what should I do? Should I really look at something else? So these kind of questions again, the moment you start thinking too much, the moment you start taking decisions on recent events, right? Look at last 2-3 days, how probably geopolitical issue has played out for India. Now you would want to take decision on it. Okay, now should I really exit equity? If the war were to escalate, then what should I do? There are a lot of these interventions we think based on our recent experiences, what we've seen in the recent past. That is again the influencing factor for our decisions, isn't it?
In your opinion, how investors can be wary of their own behavioral biases? What can they do so that they don't get over-influenced by these biases and are able to stick to their plan?
Look, as human beings, we are emotional in nature. And we want to be wearing our emotions on the sleeve, you can't really avoid everything. The first thing is to accept that, look, the decisions can be emotional also, not always logical, right? I mean, because there are some investments which are close to your heart, some are not. I mean, you ask relatively seasoned investors, they would say, look, probably I like real estate. Some people would say that I like gold. So we all tend to have our favorites. The first thing is to accept that money is a logical subject. You can't have favorites there. At the end of the day, you need to look at your investment goal, investment objective, risk appetite, all these factors which influence which investment option you should choose for. That's number one. And accept or try to identify, okay, what are those biases probably which influenced you last time to take those decisions. Maybe start taking note or keeping a journal on the investment decisions what you've taken. Let's say, for example, in the last 1 week, if you've decided to do something, let's say at some correction, you would have invested some money. Try to record it. Why did you invest? And then try to analyze, right? Because we always, when something happens, we always generally tend to react. After some time, we slowly start thinking more, and then the response, the quotient of response comes in later. So try to respond to a situation more than reacting. I think being aware itself is what I think should be the first step from an investor point of view.
What about sticking to an asset allocation plan and just being mathematical about it and rebalancing as and when there is a correction in the equity pie of your portfolio, which is, say, sharply below your targeted asset allocation to equity? Can that kind of a mathematical objective approach help when it comes to biases?
Oh yeah, of course. I strongly believe the concept of asset allocation should come in, especially when everything is going well, right? Had you safeguarded your general asset allocation mix, like people say that, right? I mean, when you're looking at investing for long term, invest in a combination of equity and gold, or maybe you can consider equity and international equities and so on. I mean, there can be multiple combinations.
Or equity and debt, for example.
Equity and long-term debt. There could be multiple combination of these asset classes, but at the end of the day, you got to stick to.
Just to clarify, may not be a long duration debt. It can be equity and short-term debt.
What I meant was debt is, for example, some people would say, look, I would love investing in PPF, or Sukanya Samruddhi Yojana, which gives me tax-free interest.
Okay. You meant long lock-in or long tenure debt. Okay, sure.
Long tenure debt, especially when markets are bad, it would at least give you that whatever promised return they're delivering, and that is tax-free. It makes more sense also to look at when markets are doing good. Be mindful of your asset allocation. Don't go overboard on certain asset class because it is doing well, right? I mean, now people are shifting more towards gold because gold has done well in the recent past. So be mindful of these asset allocation or asset classes per se. The original goal, what you thought of, be mindful of it and do these periodical rebalances, right? I mean, you set your frequency of, let's say, for a year and a half, what is the frequency you're looking at, and then try to rebalance your portfolio at that time. That could be a good approach to mitigate situations like this or scenarios like this.
Thank you, listeners, for joining us today. If you liked this episode and would like to hear 2 more such interesting conversations, do log into our channel, Why Not Mint Money, on Spotify as well as other platforms, where you will find me omnipresent. Also, if you have any new ideas or suggestions, you can DM me on Twitter. My Twitter handle is @Jash Kriplani, that is JASHKRIPLANI, or y'all can always mail to us at mintmoney@livemint.com.
To stay updated on this podcast, follow us at HT Smartcast on all the major social media platforms. To listen to more such podcasts, log on to www.htsmartcast.com.